Some factors are not easily quantified. Like in political analysis, if you want to you want to include if there is political unrest, currency should go down. How you quantify that? Political value is 0.5. What does it mean? It's really hard to quantify the objective or the nature of the variable. If the nature of the variable is objective, then it is really, so it's subjective, then it is really hard to quantify that data. Number 3, regression coefficients may not remain the same. It is mathematical term. So it says that the relationship, for example, we run the simulation about the American president, and we find out that whenever there is a election, the currency will be up or down by a factor of 0.05, 5% up or down. But this time, the currency will go up by 10%. Currency is going up and down, but the coefficient is not constant. The previous model was 5%, but now this model gave 10%, right? The biggest problem is that, the biggest limitation of this fundamental is that we don't know the timing. It will occur, yes, but we don't know the timing. Market-based forecasting. Market-based forecasting means when we use market data. What is going on to the market? What is the market data? Spot rate. If you use spot rate to predict the future rate, spot rate, it means you are using market-based forecasting. It means all the variables or all the data you just copy from the forex market. So we know that how we're going to predict the future. Forward is equal to spot 1 plus P, right? This is the premium. So here we know that premium is equal to forward over spot minus 1. You can predict if the value is increased, it means the premium going to be increased. It means currency is going to be appreciated. If premium is going to be decreased, then you predict that, okay, the currency going to be depreciated in future. So the forward rate should serve as a reasonable forecast for the future rate, because otherwise speculators would trade forward contracts to capitalize on differences between forward rate and the expected future spot rate. If forward rate is not equal to expected spot rate, this expected spot rate that would happen, that would be the value after 30 days if there is a 30-day forward. If this is not equal, then there is opportunity for arbitrage or opportunity to make profit. That's what they are telling here, speculators, right? So that is why, but here we don't use any economic factor here. We don't use country performance. We don't use any economic variables. We are not seeing the history. We are just using market data to find out the future. That's it. We call this market-based forecasting. So long-term forecasting with forward rates. Long-term exchange rate forecast can be derived from long-term forward rates. Remember this one. You need to compare apple to apple. If you are forecasting long-term rate, then use long-term forwards. You cannot compare. If you are predicting forecasting of the currency for 5 years, then you should base your analysis with a 5-year forward contract or forward rates, right? So like any method of forecasting exchange rate, the forward rate is typically more accurate when forecasting exchange rate for short-term horizon than for long-term horizon. So saying that if the forecast period is high, chances are that there is more. Here we go. Like any forecasting method, the forward rate is typically more accurate when forecasting exchange rate for short-term horizon than for long run, because in long run anything can happen. So long-term forecasting has a margin of error higher if the forward rates are used for short-term, then short-term horizon the analysis is more accurate, right? And now the question is whether the IFE it can be implemented in market based, because this concept is fundamental. Since forward rate captures the interest rate differential, therefore expected inflation rate between two countries, it should provide more accurate forecast for currencies in high inflation countries than spot rates. Since the nature of IFE is that the this is interest home minus interest in foreign. Since the formula use market data, so we can also use IFE implications to forecast the forecasting using market-based analysis as well, right? And it also provides accurate data. Why? Because the fundamental and history shows that whichever country experience high inflation, over their exchange rate will go down. The mixed forecasting, which means you are not just basing your analysis on just one, you are using a mixed analysis. Either you are using technical and fundamental both, or either you are using fundamental and marketing both. So mixed forecasting is then weighted average. For example, you give weightage. For example, market analysis, market based forecasting, you are giving 50% weightage, and then you are giving fundamental 40% for fundamental. You run all the forecasting and you are giving 10% to technical, and whatever the value come, you base your analysis on the best basis of that one. Simple. So guideline for implementing a forecast: all managers of an MNC should rely on same exchange rate. All managers, right? It's not like that the CFO is saying something else, the financial manager is saying something else, but that person who is forecasting is saying something else. So that's why there are meetings and they just discuss about the point of view. CFO may be more, inclined towards the fundamentals, and the person who knows the international finance, he may say that, sir, use mixed forecasting, right? And all the person, they come onto a point and then they make plans. So here we go. This is the exhibit 9.2 from your book. So these are the forecasts of the Mexican peso drawn for each forecasting techniques. So if you just based your analysis just solely on the basis of recent movement in pesos, it means you are using technical analysis. And how you can use that? The peso value decline below a specific threshold level in the last few weeks, and your forecast is that the peso value will continue to fall now that it is beyond the threshold level. Fundamental forecast is that you see economic growth, inflation, interest rate. Situation is that the Mexican interest rate are high and inflation remain low. When inflation remain low, it means it will appreciate. Remember your discussion, real interest rate and the nominal interest rate is equal to real plus inflation. If inflation is low, it means real is high. So you see, the peso will rise as US investor will capitalize on high interest rate. So you need to pay very close attention to that one. Since you are using some logic theory or fundamentals, so we call this fundamental analysis. Market based, your base or your factors are spot rate and forward rate. Situation is that the peso forward rate exhibit a significant discount, which is the attributed to Mexico's relatively high interest rate. So based on your forward rate, which provide a forecast of the future spot rate, PCO will decline. Why? Because forward premium is, forward percentage is negative or low discount. It means PCO will decline. Any question?
Mayo.
Mayo? Okay. Let's talk about the forecasting under market efficiencies. I think this is our last or maybe second last topic. After that, we will be finishing our this chapter. So it's up to you. If you want a 15 minutes break, we can have it. Otherwise, we'll just finish early and
Sir,
you can just go home.
we have Chinese oral exam tomorrow, so some of us have to prepare. So can we finish early fast?
Okay, let's do that. So forecasting under market efficiency. So there are three types of efficiencies. Number one, weak form of efficiency. Number two, semi-strong form of efficiency. Number three, strong form of efficiency. Weak form of efficiency means historical and current exchange rate information is already reflected in the today's exchange rate and it is not useful for forecasting. You got it? It means if in a country there is weak form of efficiency, it means in exchange rate, the exchange rate reflect all historical